All right, so if I can just start this group's lecture then with it's a presentation. It's nothing that's in the material, but I just want to give you just an overview as to what it is that we're covering in this FAC4862/4 syllabus as a whole. So we've got the two papers, the groups paper and the IFRS paper. Okay, and in the groups paper, really what we've got to look at, it's just a little diagram that I'll draw, is what we end up happening always is that a holding company or an entity always has an investment, okay, in an investee entity. And we've got to establish how it is that we account for that investment. All right. So we're going to account for that investment, first of all, in the separate financial statements. Okay, and the separate financial statements are the financial statements of that entity. So in other words, in H's financial statements, they've got an investment, which in accounts 1 you looked at as, debit, investment, credit, bank, and that was it. You had an investment, and on that investment you might receive dividends. We'll look at that in a little bit of detail. And then we've got a separate set of, well, not a separate, I'll say that again. We've got another set of financial statements which represents the group. Okay, so please understand this. At the outset, both H and I are going to prepare separate financial statements. And in so doing, they've got to comply with IFRS. Okay, so both companies prepare their own financial statements. Okay, and those financial statements will comply with IFRS. In this group's paper, we look at something different. So we don't look at the separate financial statements as such. Okay, that's what we do in the IFRS paper. What we look at in this paper is where there is a need to prepare. I call them group financial statements. Okay, the only specific reference in IAS27, they talk about consolidated financial statements. But let's then just talk about where we prepare a set of financial statements that puts those two together. Okay, so I'll call them group financial statements. There actually isn't a definition of group financial statements in IFRS. Okay, the reason I refer to it as group is because consolidated financial statements, okay, that's what we do when we have a subsidiary, and then the other one is equity accounted financial statements. That's when you have an associate or a joint venture. All right, so what we're going to be doing in this paper a lot of the time is we're going to be discussing, we're going to be preparing journal entries, we're going to be preparing financial statements. Okay, but when in this paper, it'll be in this group context over here. Right. So there are some separate financial statement aspects that we need to look at. Okay, but we'll look at those in isolation as and when it is necessary. Right, but typically everything we do here is in a group context. Okay, so it revolves around, should we be consolidating, should we be equity accounting, and then the technical detail around that. How do we consolidate? How do we equity account? So my next little diagram then, or my next little thing I want to talk about is when is it that we do what? All right, so the first question that always gets asked, when an entity invests in another. So when you have an acquirer and you have an acquiree, all right, the first question you always ask yourself is, does that result in control? Okay, and if it does result in control, then what ends up happening is we consolidate. Okay, so the group financial statements will then be consolidated financial statements, right? And we refer to that investee in that particular instance as a subsidiary. Okay, so we're going to consolidate the subsidiary, right? And that, in terms of a standard, gets done in terms of IFRS 10. Okay, so that's the accounting standard that you look to for guidance on preparing consolidated financial statements. So if you want to know what control means, it's in IFRS 10. If you want to know what consolidation means, it's in IFRS 10. Right. Do you have control? Yes. Do you have control? No. Okay. Then you've got another question that needs to be asked. And that one is, do we have joint control? Right. That concept, that concept of joint control is in IFRS 11. Okay, so it starts off, you will see when we look at that standard, it starts off with control. So control is an absolute principle, all right? Sometimes you have absolute control, sometimes you'll find we have this degree of influence which we call joint control, all right? Where you do have joint control, we refer to the investee as, or we refer to the situation as a joint arrangement. Right, so if you do not have control, the next question technically is, do we have joint control of a joint arrangement? Right, and then if the answer to that is a yes, all right, we then need to decide on whether the joint arrangement meets the definition of a joint venture or a joint operation. All right, so for test 1, there's not a lot of discussion around that. Okay, that is something that you guys are going to have to be able to do for test 2. Right, so that distinction, discussing and determining which one it is, okay, that's going to be a test 2 issue. However, if we have a joint venture, all right, there we are going to equity account, that is the accounting. We're going to equity account, and that, people, is in terms of IAS 28. Okay, so just to point out, that is part of test 1. Okay, so you may very well be asked to equity account, to prepare journal entries, whatever the case may be, in terms of IAS 28. All right. A joint operation, there's no coined phrase. So I say consolidate your subsidiary. I say equity account your joint venture. They don't really have a name for this in IFRS. Okay, I'm going to just come up with a name. This is basically what they tell you to do. Here we're going to proportionately account. Right, and that will be done in terms of IFRS 11. So just so you understand this, or how the standards are set up, all right? In IFRS 11, we may well establish that we've got joint arrangement. Then you've got to ask the question, is it a JV or a JO? That I'm not getting into in a lot of detail now. If it's a JV, if it's a joint venture, then IFRS 11 sends you to IAS 28 and says, okay, if it's a joint venture, you're not going to account for it in terms of this standard, go and account for it in terms of IAS 28. Okay. If this here was a no, okay, so if it's a yes, you're either going to be in equity accounting or proportionate accounting. If it's a no, the next question you've got to ask yourself is, do we have significant influence? Okay, significant influence. The definition of significant influence is an IAS 28 concept. So in terms of IAS 28, they will tell you what it means to have significant influence. Typically what it means is to have significant influence over the operating policies and procedures of the other entity. So it's quite a loose term, all right? And if you do have significant influence, if that is a yes, right, then we have an associate. We refer to the investee as an associate entity, and that associate entity is equity accounted for in terms of IAS 28. Right. Just to reiterate one more time, when I'm drawing this diagram for you, the question I'm asking is, how do we account for the sub, the JV, the JO, the associate in the group financial statements? Okay. Remember that if we go back and look at this picture over here, remember that our H company and our I company, they prepare separate financial statements of their own. Hey? They're two totally separate entities, both governed in South Africa by the Companies Act, okay, in terms of which both of them have to comply with IFRS. So they both have their own board of directors, their own shareholders. They two totally separate entities. Okay. And they will comply with IFRS. What we're talking about here is we're talking about what does that relationship mean? Okay. What degree of influence does that investment result in? And what I'm telling you here, it either results in control, in terms of which we're going to consolidate the sub, or it is significant influence, in terms of which you equity account, or it's joint control, in terms of which you will either equity account or proportionately account. All right. So a lot of CTA is going to be deciding on which one you get to. In undergrad, all you ever got was, they made it quite clear. Listen, this is significant influence. All right. Here, I can tell you without any shadow of doubt, okay, between now and when you write ITC, okay, which is the path that we all ultimately on, right? You will be having to have a number of discussions in terms of which you could decide, do we have control? Okay, that can be up to a 30-mark discussion. All right. Do we have joint control? That's probably a 15 to 20-mark discussion. Do we have significant influence? Okay, a 10 to 20-mark discussion. All right. And then once you've done that, then they might say to you, okay, now what are the journal entries? Or prepare the financial statements. So you've got to show then your technical prowess in actually doing that. Okay. All right. If this is a no, let's put him out here. He's a bit of a weird one. If that ends up being a no, if we don't have control or joint control or significant influence, then that investee is nothing more than a financial instrument. Okay. So then that's going to be, okay, which for all intents and purposes falls outside the realm of this syllabus. Okay. We do IFRS 9, but we do it in the IFRS paper, in the 48613 paper. Okay. All right. So that's the big picture. All right. And then we need to now discuss, how is it that we account for each one of those. All right. So the next question then, and the question that's just been asked, is how is it that we account for subs, JVs, and associates in the separate financial statements? Okay, to that end, I've actually got a deck of slides for you, so you can find this for me then. It's the very first one you've got there. It's IAS27. And really, just running through those slides quite quickly, the first one there just asks us, what's the objective of the standard? Quite obviously to tell us how to account for the investment and how to account for dividends of subs, JVs, and associates in the separate financial statements. Okay. And then the scope of the standard, that's one of the things that we always have to look at or look out for. It's fairly obvious in this one. Some of the standards, you'll see it's not that obvious. And one of the things you'll see that they do in these standards is what SICA or what the ISB, loves to do is they love to tell you what's not in the standard. So it says it covers everything except boom, 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 instead of telling you this is what's in. All right. This is one of the easier ones. Obviously, the scope of the standard includes subs, JVs, and associates. Okay. Just take note, joint operations are not part of this. Okay. So JOs, so a joint arrangement that is a joint operation, all right, is not accounted for in terms of IAS27. As I said earlier, the two definitions they've looked at here, consolidated financial statements, okay, which is when you consolidate a subsidiary, right? For whatever reason, okay, these standards haven't come up with another name to incorporate joint ventures and associates, right? So I will often use the terminology group financial statements, okay, which simply means group financial statements would include consolidated subsidiaries, it would include equity accounted joint ventures, and it would include equity accounted associates. All right. Versus the separate financial statements, okay, and that's the question that basically has been asked over here. So if we just look at that quickly from an accounts 101 perspective, all right, how is it that we account for a simple investment? All right, and basically in accounts 1, we would have gone debit investment, credit bank, all right, or if you paid with gold bars, it would be some other asset. If you bought it on credit, this would be some sort of, let's rather call it by a more generic name, some sort of liability. And the other thing we will look at at our level is sometimes you don't pay for it in cash. Sometimes you don't swap shares for a motor vehicle. Sometimes you don't buy it on credit. Sometimes you buy one investment and you pay with it using your own shares. Okay. Which means that this credit over here could be equity. All right. In terms of IFRS 3, we will look at that entry in a massive amount of detail later on. But let's just assume that amount is 100,000. Okay? All right. So that's how the investment would have been accounted for. The obvious thing that happens then is with that investment is usually there would be some sort of dividend that we may receive or becomes receivable. So at some point we might debit a receivable. Oops, can't spell. A receivable, or preferably get it in cash, and we would credit dividend income, whatever that amount may be. Let's assume it's 15,000 bucks. Just one thing in CTA, guys, that you have to be absolutely, it's just required, okay, is anytime you do a journal entry, you've got to say where that amount will ultimately reflect in your financial statements. So SFP stands for Statement of Financial Position. PL stands for profit or loss in the statement of profit or loss and other comprehensive income. If it was other comprehensive income, we call it OCI. And if it's the statement of changes in equity, SCE will do. Okay, so this here would have been obviously SFP because it's an asset. Obviously, this here would have been SFP if it's an asset or a liability, or it would have been SCE if it's the statement of changes in equity. Okay. All right, so just don't forget that you always have to do in CTA. Alrighty, and then that would have been the dividends. And then the other thing that all of you would have learned in your undergrad studies is you could choose, okay, for that investment, you would choose to account for it at fair value through other comprehensive income. So let's assume the value of the investment went from 100 to 120. Our choice would be to debit the investment. Okay, and that is SFP, whoopsie, 20,000. You agree that'll get you from 100 to 120. And the credit, all right, would either be, let's just call it a gain, all right, and then technically, I'm not going to get into too much detail here, technically that gain, it was your choice to present that gain as a gain in other comprehensive income or as a gain in profit or loss. Okay. So that's how you accounted for investments. Simple investments in terms of IFRS 9. Okay. Initial recognition, all right, when you buy the thing, all right, then subsequently you might receive dividends. Dividend income is always in profit or loss. And then you had a choice to revalue it or remeasure it, and then increases and decreases would either be presented in profit or loss or in other comprehensive income. That's IFRS 9 in a nutshell. All right. IAS27, we're talking not about any simple investment. Hey? We're talking specifically about investments in subs, JVs, and associates. All right. And the choice we're given there in the separate financial statements, okay, you can account for it like that. So you account for it as if it was a financial asset in terms of IFRS 9. All right. They're quite clear that you will always account for the dividends like that. So dividends will always be just other income, all right, in profit or loss. All right. And then what you need to know, which is something a little bit different maybe to IFRS 9, in terms of IAS27, you are allowed to account for your investment in sub, JV, or associate at cost. Okay, so what you're allowed to do is you're allowed to account for a cost, like that. Okay, if you happen to receive any dividends, you do that. All right, but you don't have to do that. And then now, here's an interesting development. Okay, in your syllabus for this year, all right, we will always account for the sub, JV, or associate in the separate financial statements at cost. Okay, so we are not going to be doing that in our syllabus this year. All right, in the separate financial statements, everything will always be at cost. Right, so that's really what that slide says. It says that in the separate financial statements, we can account for our sub, JV, and associate either at cost or in accordance with IFRS 9. That was the fair value option. And like I've said, for CTA this year, that is now out. All right, I need you to add a C for me there. Okay, and basically for associates and joint ventures, we are allowed to account for them at equity value in the separate financial statements. So just to explain, that was something was added to IAS27 in fairly recent years, all right? But just to explain why that is there. Sometimes you'll be a parent entity that doesn't have any subsidiaries. So you'd appreciate then you don't have to prepare consolidated financial statements. But what if you have just like one associate? And they're basically saying, well, do you need to prepare a separate set of financial statements where you account for the associate at cost or fair value, and then a whole new set of financial statements where you account for the associate or joint venture at equity value? Answer to that question is now, no, you don't. Okay. You only have to prepare one set of financial statements. Well, you've got a choice. You can prepare two with the associate at cost or fair value, and then a second set with the associate at equity value. But please understand this, you have to equity account for the associate or joint venture. Right? But what you can choose to do, if you don't want to prepare two sets of financial statements, you can choose to equity account for your associate or joint venture in your separate financial statements. Okay, that is allowed. Not a big deal there, just on the dividends. When is it that we account for the dividend income from our sub or JV or associate? And basically, it's when the right to receive the dividend has been established. Ordinarily, that will be when the dividend is declared by that other entity. Okay. Right, that's probably all that we need on IAS 27.